Welcome to the Retzel Health Law Hotspot. Health Law Hotspot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the Health Law Hotspot. I'm Ericka Adler, shareholder and leader of the healthcare practice at Retzel and Andrus. And today I'm joined by Craig Castelli, who's founder and CEO of Caber Hill Advisors. And I've had the pleasure of working with Craig before on transactions. He serves as an advisor slash banker slash broker, particularly on healthcare transactions. And so we've had the opportunity when we're doing transactions to work with Craig, who often is a partner with our client that is selling their practice. And I thought it'd be really helpful. And I welcome you for coming and thank you for coming today to talk to us a little bit about what the market is looking like right now. I mean, you and I have been doing this a long time. Definitely a couple years ago, the market was super crazy, lots of deals going on for physicians and other healthcare providers. So I'm really interested to hear from you. What do you see going on out there?
Ericka, thanks for having me back on the podcast. I'm looking forward to the conversation today. It's certainly an interesting time for M&A, and I can give both a glass half full and a glass half empty view on what it's like to sell physician practices right now. I heard an interesting line on another podcast a couple days ago that I'm going to steal because I think it sums things up pretty perfectly as to what's going on right now. The markets are very open, but they are unforgiving. And so there is a lot of appetite for deals. Dry powder is still flush in coffers. Private equity firms and strategics have money to spend and incentives to spend it, but they're very demanding about the quality of the business they want to buy. And I think, there's really an acute focus on healthcare practices and, the quality and differentiation of the businesses, really driven by the fact that they've experienced challenges with their own healthcare investments, these last couple of years. And so, the somewhat downside view is that, valuations peaked in the 2021 to 2023 timeframe and have come down since. The upside view is I still think we're sitting around 90th percentile of all-time high valuations. So you didn't necessarily miss the boat by very much, and it still can be a great time to sell a business if you're prepared and if you have a quality company that aligns with what investors want to invest in. And we can unpack all of that, but I figured I would just start there to set the table.
That's a great place to start. So let's say they're being a little bit more picky now about the practices they want to buy. Can you give us a sense of, what they're looking for and what they're not looking for compared to what you've seen in the past?
I think the biggest challenge that everybody's faced in the medical world is doctor retention and the succession from the senior partners who are the owners of the business and have really driven the growth up to that point, and transitioning to associates or junior partners who need to fill their shoes, pick up that slack, be backfilled themselves, and establish that continuity. There was a cycle for a period of time where everybody was promised that the rollover equity was free money and it was guaranteed to appreciate at a certain point, and everybody would get liquidity when the fund got liquidity. And in some cases that has been true and proven itself to be fantastic investments. In others, there's a disproportionate number of doctors who are expecting liquidity. And so a new investor coming in has to, begs the question, what am I actually buying? What doctors are going to be, sticking around and motivated if they all get, too much liquidity? And so that's challenged a lot of these portfolio companies. That's led to the rise in hold periods of a lot of these investments. So first and foremost, as a medical group, as a dental group, have you solved some of those problems for the buyer as opposed to expecting them to sell for you? I think if you're a smaller practice, one doctor, a couple doctors, you're all owners, there's a little bit of a reset in the expectations in terms of how long you may have to either work for the practice or have your rollover equity, tied up before you can realize liquidity. If you're a much larger business, dozens of providers, you have a little bit more insulation from that risk because everybody's going to be at, different stages of their careers, phasing out different, retirement timelines, and you can present a business that's, a little bit more transitionable, if that's a word, to an investor coming in. So I think, first and foremost, that's probably the biggest thing that's changed. A lot of what I'll say about being ready to sell otherwise is the same advice I would have given 3 years, the same advice I would have given, 10 years ago. Is your business growing? Is it profitable? Do you have clean financials that you can present? Even if you're running a lot of personal expenses through the business, there's been some fluctuations. Can somebody come in, clean that up, demonstrate to a buyer what the P&L looks like under new ownership, preferably in the terms and using the accounting methods that they would use, as an owner of the business, which may be different from you as an owner operator. Do you have good dashboards and KPIs so they can drill into the specific things that they know will move the needle on an investment? Your specific bill rates, bill codes, utilization, production of the different doctors in the practice. From 30,000 feet, there's not a whole lot that has changed about what makes that A or A plus asset. It's that growing business that has great profit margins, that has great doctor retention, that has the right mix of payers and procedures for the market. What has changed is that 3 years ago, 5 years ago, you could have been a B at most of those criteria, and somebody would still come in and offer you a very impressive valuation. Today, you really can't falter at more than perhaps one or two of those criteria if you want to, very easily and cleanly get a deal done.
Right. I would agree. I also see that even with the great practices, we're seeing offers that are, maybe the total number is still good, but less cash, maybe more rollover, more payment over time, maybe through a promissory note, more earnouts, more clawback. So a lot more features that allow for an adjustment, as opposed to a more generous upfront purchase. Are you seeing that as well?
In some cases, yes. Some of that may be buyer or specialty dependent, but a lot of it is business dependent too. We are still getting deals done, in the right situations that are just cash and equity. You can't get rid of the rollover equity. It's always going to be an important part of the deal structure for a private equity buyer. Sure, if you sell to a hospital or another group, you might be able to avoid that. But if we're thinking the PE world that drives clicks to articles and podcasts and everyone wants to hear about, rollover equity really is fundamental to getting those deals done. But if we have a deal that is 75% cash, 25% rollover equity, no other structure to it, we think that's pretty seller friendly. And we still are seeing that in the right circumstances.
Right. I see that as well. I used to see more cash, less equity, and I sometimes feel like they're pushing more equity so they don't have to come up with the cash, whether that's the case or not. Are there any particular specialties that you're seeing as being particularly, hot now or less attractive now as compared to a few years ago?
Infusion. This is not necessarily new compared to a few years ago, but infusion is still hot to this day where, some others have tailed off. Infusion is very hot. Anything around pediatric services, whether, we're seeing roll-ups in traditional pediatric medicine in the last couple of years, newly formed platforms, pediatric dentistry, especially when combined with orthodontics, is probably the hottest space within overall dentistry. Getting into, behavioral health. There's been massive attention turned to, various, behavioral health services geared towards pediatrics. That area especially has a severe shortage of providers. Other than the Northeast and the Mid-Atlantic, you just don't have enough child and adolescent psychiatrists practicing in any other markets of the country, let alone other, services. And so, that's an area where, there's opportunity across, the value chain. Med spa is another new one. Med spa getting into the various wellness and longevity services. So we started to see the med spa roll-ups coming out of the pandemic, probably let's call it 2022 was when we really started to see the heat increase around that space. It's still a sector that everybody likes today, but what's a new angle there is longevity. It's the big buzzword, and physicians and nurse practitioners are launching these longevity focused clinics. It's a little bit of the wild, wild west. Some are great operators operating, by following all compliance standards, following the law right, and offering sound medicine. Others, not so much. I won't get into procedures or drugs or anything like that, but I know what my doctor would say is good and what my doctor would say, don't ever, try that. Yet you can find somebody who's willing to write you a script for it or sell it to you over the counter, in some of these clinics too. And so, there's some of that to be sorted out, but, I think the winners in that space, I don't think that's a category that's going away. I don't think that's a concept that people our generation will stop paying attention to. And so, I think there's a lot of business to be built in that category.
Yeah, I would agree. And that's a very highly regulated area. A lot of people aren't doing it correctly. As hopefully, some of that will kind of get corrected as we go along. Are there areas that you saw were hot a few years ago that have kind of tapered off? I mean, I know, for example, we used to do a lot of derm and aesthetics, and we still do, but certainly the volume from a few years ago, I don't know if it's because they grew the private equity bought up so many so quickly. They feel they've gotten all the good ones. Do you agree with that? And are there other areas that you've seen drop off as well?
I agree with that. I think dental, derm, and ophthalmology are three areas that were really hot a few years ago that have slowed. And a lot of it is a function of, these portfolio companies being held for longer than anticipated, and they're having a hard time getting liquidity up market. They may still be interested in add-on transactions for those companies, but they're less interested in new platforms. The exception would be some of the differentiated niches. So I mentioned pediatric dentistry. That's somewhat immune from those forces. Certain med spas, which the aesthetics that are derm adjacent, still attract buyers. But pitching a new platform in those categories is definitely a little tougher than it was a couple of years ago. We did a deal in February that, unfortunately we're not allowed to talk about, but it was in the dental space. It was a very, very differentiated niche within dental. And because of this differentiation, there were literally two businesses at scale in the country doing what they do. All of what I just said was ignored and didn't apply to this deal. There was a ton of interest. It was a great multiple. It was a very clean transaction structure. But a run-of-the-mill GP practice that looks like the 70 platforms that came before it wouldn't have that same outcome unless they too had some real differentiating qualities to the business.
Right. We're seeing direct primary care, concierge practice interest from private equity. Are you seeing that as well?
Yes, absolutely.
I really see that as a big area. I know we have created a lot of those practices, and I see that as a really big growing niche in the market as we go forward. I guess, on a related point, a lot of these deals that we did, let's say right around the pandemic, 5 years ago, the doctors have now worked their full 5 years. We're starting to see some of those deals come undone because the doctors have given the notice after working the time period they were supposed to. Some of them have gone out and started other practices, maybe with the hope of selling again. Are you seeing any of the deals that you did start to come apart, or are you mostly seeing that people are happy and continuing on even beyond that commitment period?
So when you say come apart, are these doctors buying their practices back, or the episodes being dissolved, or the doctors are just moving on and doing something different with their lives?
We've seen doctors buy their practices back. We've seen them give notice where there was someone else to take over. And we've seen them give notice where they were unable to find someone, but the doctor had satisfied their obligation. In some cases, maybe an office had to close, etc. So we're seeing kind of the some have planned well, some haven't planned well in terms of the buyer for what would happen at the end of that time period. But it's interesting because the volume was so high between that time period that you mentioned, we're really seeing a lot of them kind of come to fruition at the same time, right?
Yes.
So I'm just curious whether you're seeing any of that at all.
I think we're seeing more of the satisfaction of the employment agreement and the ability to, resign, retire from the practice, move on, do something else. Obviously, may still be governed by some level of an employment non-compete, but they have satisfied all the requirements so that their equity is hard and they don't, forego any of that. And it becomes the buyer's problem at that point to deal with the succession. The only times we've seen kind of wholesale divestiture, of practices are in the bankruptcy situations where, lenders have had to come in and repossess the businesses. And then ultimately, they tend to end up breaking them up, whether they're selling them off in regions to different groups or selling them back to, doctors at a discount typically. And that's certainly the minority of cases, but it is happening. And I think it comes back to this same topic of they wouldn't have to do that if they have that doctor continuity puzzle solved.
Right. I think it's kind of an exciting time because all these entrepreneurs that sold their practice, a lot of them, not all for sure, but some of them are going out and starting new practices. So it'll be interesting to see whether we have a new wave of practices getting sold in a couple of years.
If you're a doctor entrepreneur, you have been able to make hay in this, these last 2 years. If you've had good, even just bank financing and a little bit of a risk tolerance to go out there and buy practices, you're filling a void that a lot of the DSOs and MSOs have not filled as fully these last couple of years. And we've seen some of the doctor groups, doctor-owned groups grow pretty considerably. And you're right, they will become, they're not growing for any reason other than to build something to sell down the line. In most cases, there are always a few exceptions, but in most cases. And so I do think we're going to see a new wave of this generation selling their practices at some point in the future.
Definitely. So one last question I wanted to ask you. A lot of doctors, find in a very organic way buyers for their practices. A friend sold to private equity and said, "Oh, hey, I have a buddy who does the same thing. Let me give you their name." And so I often work with groups that have already signed an LOI and are ready to do a deal. And often they lack some of the support that they may need, because getting a deal done requires more than just a lawyer. A lawyer does legal work. A lawyer doesn't do the financial and some of that background type work, or at least most of us don't. I guess I'm kind of curious, for my practices that are listening to this, what do you see as the benefit of bringing in a partner such as yourself? I mean, I understand you can help, find a buyer as definitely one of the most important things if someone can't find a buyer. But I know there's so much more that you and your group bring to the table. And I don't think everybody really understands all that legwork that is involved. Maybe you could talk to that a bit.
How much time do you have? Because I love talking about this. It's not hard to find a buyer, especially today. And there's always an assumption that most of the value we bring is simply identification of the buyer. And that's very important. It's a crucial part of the step. And, we have employees on our team who spend the bulk of their time covering the buy side, understanding who relevant buyers are for different types of businesses and helping to craft these buyer lists. So I don't want to downplay the fact that, access to buyer is a value that we bring. But the reality is it's so competitive for deals right now. Private equity firms and, larger acquiring organizations are devoting more and more resources to sourcing deals directly. They used to just rely on firms like ours to send them deals and they would bid on them. And that's gotten more and more competitive that they try to find the deals on their own. And they realize that they have a competitive advantage if they're in a one-to-one conversation with a business owner that, they can probably get a better deal, whether that's headline price, structure of the payment terms, structure of other aspects of the deal itself, because they've done hundreds, if not thousands, of transactions. And chances are the seller on the other side of the table has never sold a business before and certainly doesn't have access to, the vast market knowledge. They also don't have access to data on the performance of the buying entity or the private equity firm that controls the buying entity. And they probably don't have experience in, the data gathering in an organization and positioning the business for sale. So, drilling down a little bit more specifically, we love talking to people who come to us and say they have an LOI in hand. And, the first question is, do you think there's really a great fit between you and this buyer? And is your goal to get a deal done with them as long as we can validate the valuations right? Or do you not really care so much? You don't know enough about them to have that conviction, or you just want to sell to the highest bidder, whomever, that may be. That then sets us on a path. Either way, we're digging into their financials, we're digging into their, business data, their clinic level data, and determining what we think the market should pay for a business like that, what we think the structure of the deal should be, and who the best buyers are. We also spend that time getting to know the owner, the partners, the culture of the practice, the overall dynamics, because that also helps tell us, okay, buyer A versus buyer B, who will you feel better, partnering with for these next 5 years? Where is the cultural alignment? Where is the philosophical, alignment? Because these deals are marriages; they're not divorces. You are likely working there for a number of years, and you are working with the people that you are selling to. All of that is happening before we've even had conversation number one with the buyer or buyers. Then it gets into the actual presentation and negotiation, and we can diagnose where the buyer is going to get excited, where are they going to have heartburn, what is going to cause them to attempt to potentially retrade the deal down the line. Our goal is to make sure that never happens. And we do a pretty good job of kind of working with sellers through that lengthy due diligence process once they've signed an LOI, to preserve the price and to preserve the terms, and make sure that they don't get burned, anywhere along the way. But it's also about setting their expectations accordingly, because there are going to be a lot of tough conversations that they're going to have defending their business. And if not prepared properly, not only can they, perhaps not answer the questions to the best of their ability, but they also take offense at things that they really shouldn't take offense to. Somebody is about to spend, millions, if not tens or hundreds of millions of dollars to buy your business. They should have the right to ask you some tough questions and see how you answer it. So, it's that holistic view, but, we have the stats to back up, that this works. I can tell you a story of a doctor who came to us after a couple false starts trying to sell his business on his own. He was approached by an independent sponsor, offered him $19 or $20 million for the business. He thought that was a great price. Sponsor couldn't get financing. Asked his attorney to introduce him to a couple, PE funds that the attorney knew pretty well. Had a couple conversations, got the bids up to $30 or $32 million. Thought he was doing great, master negotiator. They ended up passing for, one reason or another, and withdrew their bids. And then, finally decided, okay, I need to hire an investment banker. We got connected. We ran the process. We sold the business for $60 million.
Wow.
It was the same business. It had grown a little bit. It certainly hadn't doubled or tripled in size, but it was a function, of, he had a great business that somebody should pay that for, with our market knowledge and the way we structured the process, and the way we worked together hand in glove with the various service providers. We brought in a great Q of E team. He had a great legal team, and Ericka, you and I have had this experience together too. Once we get into really the deep stages of the deal, there are going to be issues that arise that are not binary. This is either a legal issue or this is a business issue. Sometimes they're both, and we have to figure out, okay, you tackle these topics with the other side's counsel, I'll tackle these topics with the PE partner or the CEO, and having those multi-level relationships that we've built through the course of the deal, or potentially in our case with some of the funds we work with, built over years, allows us to really fast track the resolution of those issues without building up any resentment or hard feelings over what at the end of the day is just a very difficult business negotiation. So it's not one reason, it's many reasons why I think we play a very valuable role in this deal ecosystem. It's very tempting to say, hey, I know a buyer, I can save a few bucks, but you could also probably cut your own hair. Is that really a good decision?
I agree. And I think sometimes clients assume that lawyers can play a much bigger role than they can or they should, right? I think it's important for lawyers to stay somewhat in our lane. I don't give financial advice. I shouldn't be reviewing someone's financials, or they shouldn't be relying on my review of any financials, right? That's not my role, my expertise. That's not what I'm licensed to do. Also, I can only talk with other lawyers, right? I can't talk with their business people. And a lot of the deal gets done. A lot of the issues get worked out with the non-legal people. You can have those discussions. I cannot have those discussions. So it is kind of a split process, which is why, and I think we've had this conversation before, surrounding yourself with a good team is so important, right? You've got your legal team, you've got potentially your tax planning, your financial team, you've got your deal team with someone like you. So I think, knowing who your team is and knowing the role they play and letting them kind of help you together really gets the best result at the end of the day. So
yeah, absolutely. And that's one piece of advice I would give to any of the practice owners watching this is I've seen on occasion owners, and this is not just doctors, we see this in our non-healthcare businesses too, they have a tendency to silo their service providers. And they think that gives them control of the process. And they think that perhaps it also gives them a little bit more control of their fees because they worry if I pick up the phone and call you and we talk for 15 minutes, they're going to get a bill. And maybe they will, and they probably should, because that may have been 15 minutes that saved 2 hours of work down the line. And so having us in sync from day one on the deal is really going to lead to, a much, much better outcome, because then when we get into those latter stages again, you and I might have 22-minute phone calls in a single day as we're hashing out the final issues. And one of my associates, the same with one of your associates, and we're going to close the deal 3 weeks faster, more closer or at or above the terms that we originally expected, because we're in sync like that.
Right. Absolutely. Guys, this is a topic that we could really go on and on. I mean, it's a huge topic, and these issues come up repeatedly. What I'm hoping is that some of the practices that are listening to this will feel free to reach out to you or me with any questions that they have. If they're interested in what's going on in the market, if they're looking for a partner to help them do a transaction, if they just have questions about how it works, right? The idea is that their information is out there. They don't have to guess. They don't have to Google. We can probably give them better information than AI can, right? On what it's really like and what the human element of that experience really is. So any final thoughts or questions or issues you want to bring up?
This has been a lot of fun here chatting, and I'll reiterate what you just said. You can email me or call me. If you go to caberhill.com and you go to my profile page, you'll see my cell phone number and my email address right there. Email is simple. It's craig@caberhill.com. I'll take a call from anybody who owns a practice and just have some questions about what's going on in the market. How does their business line up with what's out there? And, I think final thought is that, some of these specialties that are a little bit stuck right now from an M&A perspective, that's a temporary state. I can't predict, when they get unstuck. The market is still very open for those really, really high quality businesses. And we can have a very quick and frank discussion about whether your practice meets that criteria, or if not, what you need to do to get it there. But I think, in the next year to couple of years, I can't predict when we're going to see the pendulum swing again, where things open a little bit more and that activity picks back up. And I can't wait for that to happen.
Yeah, I think you're absolutely right. And I'll be sharing your contact information as well, so they'll have it when they see this podcast. And I hope you'll reach out if you have any questions. And thanks again for joining me, Craig. I really appreciate it. This has been the Health Law Hotspot. Come see us next time, and you can see our other podcasts at ralaw.com. Thanks. We'll see you next time.
The Retzel Health Law Hotspot is made available by the firm and its attorneys for educational purposes and to provide general information, not to provide specific legal advice. Use of the Retzel Health Law Hotspot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Retzel Health Law Hotspot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.